Anthony to answer. Okay, so we are recommending that clients take up Origin energy rights. Could you talk a bit about this, and is there a risk that this is just throwing good money after bad?
Yeah, I thought it was a bit topical to do this one. We've had a few questions the last few days about the rights issue that's coming up, and obviously Origin's fallen quite a bit over the past 12 months, and in fact it's actually our worst model portfolio stock is Origin, so it's fallen 50% over the past 12 months. So it's obviously not a great outcome. So there's a couple of things here. Is well, one, just to have a look at why is it actually fallen 50%, and is it still a company that we want to hold, and then secondly, do we want to put even more money into it when it's come off so far? So just looking back on it. So firstly, why originally did we have Origin in the model portfolio? And firstly, I guess it's a combination of things. It basically is the largest energy retailer in Australia. Traditionally, that's what it's been doing. So it sells energy to retail customers, and you can see there on the second line there, it's got pretty steady revenue coming through the retail business, and that gives it a pretty solid base. So we thought, from that perspective, it's that sort of traditional utilities company with pretty solid cash flow coming through. Then what they've been doing in the last 5 years or so is trying to become more vertically integrated. So actually producing the energy itself, and so it's been developing this APLNG project up in Queensland. So that's an LNG project which has been developing for a number of years, and which is almost due to be completed at the end of this year. So basically going to switch on, they're going to start delivering the gas later in the year. And so they've been pumping a huge amount of money into that, with the prospect that it would be another revenue source for them. And probably even 12 months ago, they were thinking that would potentially generate $900 billion worth of revenue for them. And obviously with the oil price and the LNG price coming off, that's not potentially that level of revenues come down now. But you can see even these are UBS forecasts. So they're still forecasting in the next few years, even based on the current outlook for oil price, it still will be generating quite a lot of revenue for them. And then so all that fundamental, that sounded good, and that's why we liked it as a company. But what went wrong? And firstly, the oil price came off, and the LNG price is linked to the oil price based on for historical reasons, and so that lower oil price has reduced the outlook for the revenue that it will get from that APLNG project, and so that's impacted. But then also on the other side is that to develop this project, they've been borrowing more and more money, and so they've been building up the debt that that's been on their balance sheet, and so because looking back in hindsight, obviously we're not going to get everything right, but when a company falls 50% that we recommend to, we wanted to see what's caused that, and can we avoid it in the future if possible, and so the first one, trying to pick future for oil prices, it's a bit like trying to predict currency and other things. It's very difficult to do. You can sort of take a long-term view, but trying to really pick short-term movements in commodity prices is very hard. So I'm not sure, going back 12 months, we could have actually picked that up. But possibly what we could have picked up is the debt and the level of debt that it was generating, because it is something that something we look at when we look at a new stock, and whether we're going to put that new stock in the model. We look really closely at the amount of debt it's got, because we know obviously the more debt a company has, the riskier it is, and so it's one of the things that we look at really closely when we look at a new company. But I think what happens with a company like Origin, when it first goes into our model, it actually doesn't have too much debt, and all of a sudden the debt's kind of crept up without us possibly paying as much attention to it as we should have. And so I think that's really the lesson that we've learned from this, is to really keep our eye on the debt that even all the existing companies we've got in our model have, and how that debt is going to potentially impact the risk of that company. So I've got some slides where I compare it to Woodside. So Woodside's another oil and gas producer, which doesn't have the retailing business. So you'd really think Woodside's earnings would be more volatile than Origin's earnings when the oil price falls. But what you can see over the past 6 months, Woodside price has come down 20% with the oil price coming down. So that's really not not unexpected, but it hasn't fallen anywhere near as far as Origin's price. And really that's got to do with the level of debt in those two, the relative level of debt in those two companies. I think, so this slide, so I went back and had a look at how much debt did Origin and Woodside have 3 years ago, and how much debt have they got now. And so you can see Origin's debt has really grown substantially as it's been developing this APLNG project. And so it's ended up being, quite a highly geared company. Well, not highly geared compared to some companies, but for a resource company, it's reasonably highly geared. And so it's got about $11 billion. Well, it was on track to have $11 billion of debt. And whereas Origin, because they finished, they started developing that Pluto gas field in WA, which they finished, and so it's now generating a huge amount of cash flow. So they've actually been reducing their debt. And so really that's sort of the key thing that's actually driven the Origin price is the amount of debt that it's had. And so then when something goes wrong and a company's got a lot of debt, it just amplifies the share price decline that it can experience. And so so then we have to think, well, what should, as we say, are you throwing more good money after bad, or should we actually go into this rights offer? And so the things that we thought about were, well, the oil price is at quite a low point, and obviously you've got all the Middle East companies really trying to increase supply and keep the price down, because what they're trying to do is stop all the higher cost producers in the US that are now producing more and more oil, and basically the US is becoming self-sufficient, so they're becoming less reliant on the Middle East for oil, and so there's all sort of political things, but one of the arguments is that the Middle East is just ramping up supply more and more to keep the price down and knock the US producers out of business, so then then they can keep supplying the US with the oil. So that's one argument, but ultimately the price will will recover, we think, over a sort of 3 to 5 year kind of horizon. And basically they've pitched the price at quite a low point that makes it really attractive to want to take up those rights. So basically you can buy the extra shares at $4, and it's currently trading about $5.40 today. So basically you make 30% on those extra shares that you get, even if you were just to take them up and sell them after. So it's pretty attractive on the basis of just that extra, the profit you can get. And then more importantly, they're actually, this capital raising is part of some other initiatives which will basically raise about $4 billion of equity for them. And so to be able to reduce that debt from $11 billion down to $7 billion and get it at a much more reasonable level, and basically ensure that they maintain their investment grade credit ratings. It means that their debt costs won't increase too much. And so effectively, overall, it just makes it a more stable business, the fact that it's doing this $4 billion of equity raising. So effectively, it's less risky now than it was 2 weeks ago before the equity raising. And then as you can see from those original slides, that LNG project should still be profitable for them over sort of the medium term. One more slide there. Yeah, so part of the guidance they provided was that basically the break-even point for that APLNG project is $24 a barrel, US $24 a barrel for the oil price. And currently we're around, sort of hovering around $50. And so it's substantially above that break-even point. And I think, so the last time the oil price was $24, that was going back to sort of 2003 kind of level. So for the oil price to get down to that far, I mean, basically nobody's predicting the oil price will get down there, and we don't think it will. So we think they still will make some money out of the project. And then if the oil price stays above Australian $1.55, then that means that it'll actually be generating enough cash flow to actually pay a distribution. So you'll start getting higher dividends out of Origin if the oil price stays above Australian $1.55 a barrel. And so at the moment it's reasonably far above that, so it's about 65. So we think the oil price will gradually turn around. Origin will start making a lot of money out of this, and so we see you then making a reasonable amount of money by going into getting these extra shares through the rights and basically holding on to the Origin shares. That's all I have. So was there any questions about the...
Anthony, with the reduction in debt, will that reflect in the share price in any way, or is not going to have any effect because of a dilution effect with an increase in shares.
Yeah, well, I guess basically it should make it less volatile. So on the upside as well, so that's right, so it is diluting the shares. So when things improve, you're not going to get the same jump in share price as you would have if they had $11 billion of debt and less shares on issue. But at the same time, it's going to reduce downside volatility as well. So it's just overall going to be less volatile from the fact that it has less debt.